bottom line. And so, if you're in a given industry, if everybody else in the industry is trading at a price-earnings ratio of, say, 10, and the company you're looking at is trading at a price-earnings ratio of 5, then you're going to look and see and look carefully and say, okay, is there anything fundamentally different between these two companies, right? If there is, then there may be a reason why it's trading at that lower multiple. If there's not, then you might want to buy that stock because you know that eventually the price-earnings ratio will start to, or you can expect that it will approach the price-earnings ratio of the rest of the industry. You see what I'm saying? So price-earnings ratio is just a valuation tool. You say what a company should be valued at. The same thing if a company is fundamentally the same as the rest of the companies in a given industry, and their price-earnings ratio is 20, and everybody else is 10. So you probably know that it's discounted to today's dollars. And so there's sort of like a standard formula on that. But just when we're looking at free cash flow, there's a lot of different definitions of cash flow. So it always has the same elements, but people can look at unlevered free cash flow and levered free cash flow and all sorts of things. But this is going to be the most standard definition of free cash flow, right? So if you gave this definition, say in an interview, nobody could refute it, because it's the most standard definition, right? So, and free cash flow means cash flow is available to, to pay debt, to take care of the needs of the business, or theoretically, to be kind of paid out. And basically what you're going to take is you're going to take earnings before interest and taxes. So again, that fundamental measure of how business is doing. You're going to add back depreciation and amortization. And then you're going to subtract off two things. The change in working capital and capital expenditure, or CapEx. And so just to briefly touch on these, on a balance sheet for a company, you're going to have current assets and also current liabilities. You're going to have other larger areas of total liabilities and total assets and things like that. But current assets will be money that you can get at within a year, right? So those are assets that you can actually turn into cash relatively soon. So that's going to include accounts receivables. So money that people owe you, that they're going to pay you within a year, usually if you have a receivable out there for more than a year, you're not getting it. So, accounts receivables are money that you expect to get within a year. Cash, obviously. Cash is, marketable securities, so stock in other companies or whatever, that you can change over pretty quickly. Those types of things will all, be included in, working capital. In current assets. Current liabilities are things that you have to pay or take care of within a year. So short-term debt. Short-term meaning it's due less than a year. Accounts payables. So things you have to pay out in less than a year. Those types of things. So the change in working capital, basically, working capital itself is the difference between your current assets and your current liabilities. So that's how much money you literally have to work with over the next year. That difference. That's how much play you have. You can be kind of taking in receivables and paying off the payables and things like that. So from one year to another, let's say my working capital, the difference between my current assets and current liabilities is $16 million. And then, next year, the next year they're, $17 million. So my working capital increased by $2 million, right? So I'm going to subtract that off because again, that's sort of a balance sheet issue. You see what I'm saying? So it doesn't really, affect the fundamentals of the business as such in terms of how much cash you're going to have available. And finally, you're going to subtract off capital expenditure. Because again, whatever cash flow you would have available, if you have to buy things, if you have to make major purchases, then that's like money that you're investing back into the business, and so you have to take that off in order to get free cash flow. So, again, there's a lot of different definitions. This is the most standard. So you want to take earning before interest and taxes, add back depreciation, subtract off the change of working capital, and subtract off capital expenditure.
No, isn't it like after taxes, so EBIT times 1 minus T?
Well, what you want to do is you want to actually get a feel for what you have before taxes and before you pay interest, because sort of everything, it's assumed that everything that happens under the free cash flow line is can be altered with a capital structure. So put it this way: you can pay your interest can be so high, right, that you pay nothing in taxes, theoretically. So like further down the income statement, you could have a lot of debt on the books, which there's going to be a lot of debt on the books in the leveraged buyout, such that you don't really earn anything as such, so there are no taxes. So just because of the fact that there are things that can be affected in a deal that sort of make those factors irrelevant, or the current number irrelevant, you leave them in. You see what I'm saying? Now stuff like, as far as depreciation, you do want to add that back because you don't want to punish the current management or the current situation, for non-cash expenses. You do subtract out the change in working capital and CapEx, because that stuff is going to keep, if a business is growing or if it's moving in a certain direction, you imagine that the capital expenditure is going to be consistent. That you need to keep making the same types of investments. You see what I'm saying? So those are fundamental. The stuff with interest and taxes is not. Like it could change, it could pretty change at any time. So not that you're planning to change it, but you just want to look at the transaction, look at the cash flows available with sort of like secondary factors, made irrelevant.
And the reason I asked was because normally free cash flow, that 1 times 1 minus T is actually operating cash flow taxes. That's
right. Yeah. Like I said, I mean, there's different. If you're, like I said, looking at it from an accounting standpoint, then there's going to be different, definition of cash flow. If we were just looking at a statement of cash flows, that we get a number, But this is what's going to be sort of used in the most standard context. The most standard measure from a valuation standpoint at any bank, or yeah. So it's sort of like from an accounting standpoint, a lot of this stuff will be somewhat different because we're looking at different stuff. Accountants are usually looking to run a business. They're not looking to do a deal. You see what I'm saying? So the taxes you pay in the real world are important, right? Because that's going to affect earnings. So for a typical public company, that's huge. The amount of debt you carry is key. But in this scenario, you want to initially evaluate it sort of clean. And at the highest level. So the other important element, and this is something that, again, for our purposes today, you need to just understand it more theoretically.